Hello, everyone. Just so you know, I'm not going to be the only person up here. My colleagues, Aaron Brodwin and Kia Kokliacheva and Hope King will be doing this. But I have one more right now. So I would like to welcome to the stage the CEO of TPG, John Winkelried. John? So John Collison, another John, was up here a little while ago, and he talked briefly about why his company's maybe never, ever going public and doesn't want to. You took TPG public last year. Let's see, Stripe is 13 years old. TPG was a scant 30 years old. You were also Goldman, albeit not CEO, when it went public. I'm curious, what experience, if at all, from being there at Goldman when it went public, and then all the companies you worked with going public, did you take into either a thing to emulate or a thing to avoid?
Yeah, well, there were a lot of actual learnings from that I took into the process with TPG. One of the things that when Goldman went public, I was on the management committee of the firm, so I was close to the process, but I wasn't, obviously in the CEO seat, so it was a different, it's different, whole different experience. But one of the things that was clear is that we had a lot of clarity with respect to why we were going public when we were at Goldman, but also importantly, communication. We found culture and communication was super important because you're transitioning a firm that had a strong private partnership culture into a public firm, and the culture was very important to the organization. So communicating and encouraging people to talk about what were they worried about. The transition from private to public is a pretty big transition. So what were people concerned about? What are the kinds of things they wanted to really retain within the culture? Clarity on why we're doing it. Communication to customers, clients, very important in terms of why we were doing what we were doing. At TPG, I think the firm, as you point out, was about 30 years old, and we were transitioning. We were going through the process of transitioning from a founder-led, founder-governed organization, a firm that's been very successful over the course of 30 years, but now thinking about how do we transition that process to the next 30 years, because founders aren't going to be around forever, so you want a thoughtful transition. And one of the things that's really important is that a broad cross-section of people in the firm are stakeholders in the firm. And one of the things that going public allowed us to do is it allowed us to transition ownership of the firm. So there's a very high proportion of the ownership of the firm that's actually owned by insiders, besides the public owning about 20% of the company. And the process of doing that, we evaluated different ways of going through that process. The process of doing that was something that was probably most efficient by taking the firm public, as well as, our business, if you've been kind of watching it, our business is certainly going through a process where size matters in our business. There's a consolidation generally going on across the private equity landscape, across the alts landscape. And so access to capital was very important, making sure that you were creating both opportunities for our LPs in terms of new strategies, new opportunities to invest, but also creating opportunities for people inside the firm. Continuing to attract and retain the best people requires you to the organization to feel like it's got momentum, like you're front-footed, you're going to grow. And so the process of going through that was, again, communication with our teams, why we're doing it, what we're trying to preserve from a structure, from a cultural perspective in the organization. So all of in that respect, there was a lot of commonalities between the two processes.
The other thing Collison said was that Q1 of 23 would be a bad time to go public. Q1 of 22 looked okay, not great.
It looked okay until the day of our IPO, and then the day after,
right,
it probably would have not gone public.
Right. So actually, I'm curious. I mean, do you, from a time, I guess kind of, do you regret going public when you went public? The stock's obviously lower than the IPO price.
No, I think we felt actually quite fortunate that we were able to get in under the wire. I mean, it was close. It was really close. I mean, if you go back and study what was happening to the market that day, I mean, the markets were basically coming under a lot of pressure. We were trying to go public, Dan, in December. And what happened is, if you remember, in December of 21, there were a number of new tax provisions that were floated in Washington, which created some complexity for partnerships. And so we were in a position where we were going to either have to potentially change our structure a little bit to adapt to that, or wait. And so we basically took the approach we were going to wait. And so we got ourselves essentially prepared in December. We did what they called our testing the waters meetings with investors. And then we had planned immediately when we came back in January, we obviously at that point had clarity that, these things the tax laws had not changed. And so we had clarity, and basically first day back, we started our roadshow, and we got it done.
So TPG is primarily known as a private equity firm. I know you have some other business lines, but primarily a private equity firm. And I was at the Milken conference down in LA last week. Almost every private equity conversation became a private debt conversation. Because private credit has become kind of such a part of the capital structures in buyouts. TPG, you guys used to have an affiliate, which was Sixth Street, which was largely a credit firm that was part in-house. It spun out several years ago. Most of your peers have private credit arms. Will TPG have one, and are you going to grow that, or are you going to buy it?
Well, we've said very publicly that we want to be back in the private credit business. There are a lot of reasons for that. It's becoming a very important part of the alts market. It's a very important part of the private capital market in terms of provision of capital, provision of credit. And if you look at what's happening with banks, a lot happening lately too. There's been a steady going back over the last decade. There's been a steady reduction in the provision of credit out of banks to the private part of the market. And then there's a lot of opportunities right now. In particular, look at the markets right now with the dislocation in valuations. One of the things that's happening is there are really interesting opportunities. We're typically, as a private equity firm, obviously we're typically in the equity part of the cap structure. But if you look up and down the cap structure from a risk return perspective, there's some pretty interesting areas. So we're definitely committed on getting back there and having a robust business. There are different ways of doing it in terms of either trying to start it organically or trying to acquire a business. We're open-minded.
There are some for sale.
We'll have to talk. Yeah. But we're open-minded in terms of considering either way at it, so we're focused on it.
You're focused on it. I'm wondering, there's some talk that the leverage loan, and again, since you used to be Goldman, there's some talk that the leverage loan side of the business is starting to make not a comeback, but it's starting to make inroads again as they drop pricing. Are you seeing that?
You mean from banks?
Yeah, from banks.
I think that the broader trend is that you will see banks play less of a role in the leverage loan market and buyout financing. I think that's the trend, and I don't think the trend is reversing. What you tend to see from the banks, particularly the largest banks, is sort of a little bit of a cycle to their appetite to lend. So, if you look back to last year when a lot of the big banks had a lot of unsold or inventory from leveraged loan transactions and buyout financing that were unsyndicated, they took fairly substantial losses on it. You see, from my experience in banking, you tend to see sort of this kind of feast or famine mentality with respect to their desire to take risk in that part of the market. And clearly we're on the backside of sort of, we got burned, we're trying to be more careful. The market was almost closed. The broadly syndicated loan market, which is what's sort of referred to as kind of the, within the leveraged loan market, was almost closed from a banking perspective for, the better part of the second half of last year. It's starting back to open back up again. But again, if you look at where if you look at where the lending is now coming from, you either have private equity firms going direct in some cases to LPs of their own that want to finance buyouts. You have direct lenders that are all private sources of capital that are large players now and have accumulated large pools of capital. So they're a material part of the market. And then obviously you have the banks. So
guys, the other thing you have, and this was on the bank side, and this is interesting because I think this is a process you guys are in, which is, I think it was JPM, it did a staple financing or has offered a staple financing for Subway, the not that good sandwich chain. And I haven't seen one of those in a big buyout for a while, or a big potential buyout for a while. Do you think that's a one-off, or do you think we're about to see a return to that, so that when you guys maybe have interest, you don't have to worry about the financing?
I think you'll see staples on and off, depending on the asset. I think that there's sort of I think it depends a lot on the asset. I think to the extent that that people view the asset as a strong company with that'll experience maybe less volatility through the cycle in terms of economic cycles. I think you'll see more of a willingness for people to put staples alongside of assets for sale. But I think it's going to be kind of episodic.
Yeah, there's talk, and I wrote about this the other day, that when you've got rising rates and you've got potentially slowing economic growth, that one of the things that could obviously happen out of that, at least on paper, from a kind of a pure economic standpoint, for a private equity portfolio is bankruptcies. Do you expect to see, whether it be a TPG or in general, a lot of portfolio bankruptcies, or is this once again kind of like it was in 2009, where Cov Light comes and saves the day for everybody?
I think probably fewer bankruptcies than people expect. Again, because of the flexibility within covenant structures, the ability to kick the can down the road in a number of these situations. I think it also depends on what happens to the economy. I mean,
speaking of which, does what's happening right now with debt ceiling, does it scare you or no?
Yes, in a way, yes.
What way?
I think that we've gone through this cycle a couple of times. And I think the assumption has always been, who would possibly allow the US government, our government, to default? It seems insane in a lot of respects. And I think that the political process has gotten increasingly heated, in some respects maybe even slightly less rational, because of the polarization. And I worry that maybe there is perhaps more of a willingness to go to the brink. And so I'm a little more concerned than I might have been otherwise. Like last time, last time we sort of were in this brinkmanship was like a decade
2011.
Right? Yeah.
I'm just curious. I mean, you've been in the financial markets for a very long time. Can you get your mind around what a default would actually mean in practice? You default on a Monday, what actually happens to the stock markets, to the bond markets, to your own companies?
Honestly, I think that it's, the answer is sort of, yes and no, okay? I mean, I think that we'll probably get downgraded as a result of a default. I mean, kind of definitionally, you get downgraded.
We got downgraded in 11 without the default.
We did. Yeah. And so definitionally, you kind of get downgraded when you default, but the long-term implications of how people perceive our creditworthiness, the reserve dynamics around our currency and how that might be affected. In this process this time versus 2011, there's one very important fundamental difference, which is that 2011 was a credit easing period and a quantitative easing period. So there was a lot of liquidity that was getting sucked up by the Fed's balance sheet in terms of buying securities, taking securities on the balance sheet, generally accommodative credit, and also very low interest rates. So sort of changes in interest rates as a result of cost of debt were not that profound in terms of debt service.
So you think a downgrade would be a bigger deal or a bigger problem in 23 than it was in 11?
I do, yeah, I do.
I want to go back to one of the other things Carlson and I briefly talked about was AI, and I'm curious your thoughts here. You started your career as an intern at Goldman Sachs, and private equity and investment banking, I guess, but private equity is viewed as this apprenticeship business where hopefully people come in and they do modeling and get some coffee for people, et cetera, and eventually hopefully work their way up to your position. Do you foresee Goldman Sachs or TPG needing interns or analysts in 2 or 3 years? Are those jobs going to be there?
100%.
To do what?
I think that, I mean, there are a lot of issues there.
Yeah.
Right? We don't have enough time, I think, but there's a lot of issues there. I mean, look, I think that AI obviously is kind of washing over everything right now. And, in some respects, it reminds me of other periods in time where, everything was kind of cloaked in, like it was when the internet was created and everybody was talking about sort of, access to information and that was sort of washing over everything. Or back with, broadband and, when everybody was thinking about like, everything.
You don't think it's more transformational than this?
Well, no,
potentially.
I think potentially look, the answer is yes, but I think we're far from okay, I think we're far from analysts and interns working on trying to identify interesting companies, trying to do do modeling work, evaluate, help with diligence around fundamental diligence around companies that you might be investing in. AI may be a tool that helps that process, but there's still a lot of creative intellectual energy that is spent and exercises around these issues. And so I have no doubt that there will be interns and analysts and associates at private equity firms and banks in whatever that time frame was you just said.
Whatever it was time frame I said. Let me ask about something totally different, because we have 5 minutes left, which is TPG Next. What is it?
It is a seeding and stake strategy to help diverse managers get into business. What we saw at TPG was an opportunity to use our expertise in how to run an investment firm, a private equity firm, how to build a GP, how to firm build, and also how to invest, and extend that expertise to diverse people that want to be in what I think of as the capital allocator seat. Because one of the problems when you talk about not enough capital flowing to diverse-led companies is you don't have enough diverse-led capital allocators, because the networks they have, the people that they know, who you call, where you're likely to connect with somebody to understand what they're doing and how they're building a business. It's very hard for people who are. It's very it's very hard for necessarily a white male, okay, to have the same kind of connectivity to a broad set of diverse people that are trying to build companies than it is for someone who's also diverse.
Can I ask about that? Yeah. How do you apply that to TPG itself? Because, and this is just based on the website, if you just look at gender, for example, only two of your 9 members of the management committee are women, only 30% of your board of directors. If it's a good business for others and for you guys to invest in, why not apply it in-house?
Well, we're obviously trying to apply it to ourselves because, we have undertaken a bunch of initiatives internally in our own firm to try to make our firm more diverse. It takes some time in terms of the life cycle of somebody in the investing role. What we've done, though, for instance, on the boards of all of our companies, we undertook a board diversity initiative in 2017. We put 400 diverse people on the boards of all the companies we either control or have significant influence on. So we've changed the makeup of the governance dynamic and the inputs that those companies are getting. And when you look at the TPG Next initiative, not only do we think that it's a smart thing to do, it's a good thing to do, but what it's doing is that it's expanding our network. It's expanding the flywheel of opportunities that we see because otherwise we don't see those opportunities necessarily. So I think it's a really, I think it's a really interesting initiative. It's kind of one of a kind in the market right now. And since we've announced it, we've had approximately 400 inquiries from various people in the market who are diverse that are interested in either building their own firm or getting into business to do deals as a fundless sponsor, at least for a period of time until they can build their own firm. And just that network itself alone and the opportunities that we're seeing come into our firm as a result of it, the process of changing the culture of our own organization is also about getting our own team and our own firm engaged in actually helping some of these managers, and that changes the culture fundamentally.
Final question for you is about part of your business, which is growth equity investing. TPG, which again, the history was a leveraged buyout firm. You guys got big into growth equity investing. Obviously had a big investor in Uber, unfortunately a big investor in Vice, and a few others. I wonder, there was a period of time, a pretty long period of time, where it really seemed like shooting fish in a barrel. Throw money anywhere and the money was going to come back and the valuations were going to go up. Things have obviously changed a lot. How differently now do you feel your team is analyzing those opportunities than they were a couple of years ago? And does it make sense to keep investing as much in that space?
Yeah. Well, first of all, I think it's important to put a point on the fact that our growth equity business was very different than a number of other growth equity businesses. I would not describe our business as sort of what I call kind of venture growth. We did invest in Uber. We did invest in Airbnb. By the way,
felt like venture growth.
That was, you're right, but I think we had a unique window on it because we were in this community here. We're located in San Francisco, and one of the unique aspects of what happened as an example, just as an example with Uber, is part of the reason that they wanted us to be an investor in the company is they felt that we could help them globalize the business because we were familiar with other markets and we were in other markets. So they felt we were kind of in a unique position to kind of join the board, which we did. But if you look at the mix of our business and the growth equity, in our growth equity business, we do as much controlled buyout, mid-market controlled buyout business as we do minority kind of pref equity investing. And if you look at the diversity of our exposures, we're very, healthcare is a big sector for us. Software and enterprise technology is a big sector for us. What we call internet digital media, which would be an Uber or an Airbnb investment, is also a big sector for us. But it's different than what you might find from other sort of venture growth funds in the market because of the nature of the diversification of the types of investing we're doing. So anyway, I think, it's definitely not shooting fish in the barrel, that's for sure. It's hard no matter what. But I think we feel like, if you look at the consistency of returns in our business, as opposed to the vol of the returns of some of the venture growth businesses, it's a very different profile.
John, one word answer because it says zero and there's people in my ear. Does the U.S. go into a recession in 2023?
No.
Thanks for joining us.
Yeah.
Be great.